Good evening. It's March 3rd, Thursday, 6:25 p.m. Welcome to episode 35, Difficult Times. Good evening to you, Wawi.
Good evening, Mark.
And good evening to our loyal listeners out there. I hope everyone is safe. Our thoughts goes out to the Ukrainians and all civilians that are in harm's way. I hope you guys stay strong and stay safe all out there. This is your host, Mark Yu.
Wally Santos.
And welcome to the Mark Yu and Huawei Show. A disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Huawei are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the makeup field, thank you guys for your hard work. For our previous episode, if you guys have missed it, we discussed the market sell-off that just occurred. We discussed the ongoing decline in consumer sentiment, the lowest in 5 months, and the ongoing tightening of financial conditions. We also run through the valuations of big tech companies, Google, Meta Platforms or Facebook, Amazon, Microsoft, Netflix, and Nvidia. We also briefly brushed through housing crisis and of course the ongoing geopolitical tensions. We also had the Roll the Clip segment, which highlighted Tom Lee, interviews by Tom Lee and Jeremy Grantham. So for today's episode, we're going to start with our weekly check for the weekly sentiments of the stock market and valuations. So for the American Association of Individual Investors, this comes every once in a week. So this week, investors turned a little bit bullish. We're back at 30%, whereas just a couple of weeks ago, we have never seen such low bullish sentiments down less than 20%. So investors, despite the troubles and turmoil there in Eastern Europe, are becoming more bullish at this point in time, and they're becoming less bearish as evidenced in this survey. The bearish sentiments dropped to 41.4% from 53.7%, which is still above the historical average of 30.5%. So for the weekly performance, so for the past week, the best performer is basic materials, up 6.7%, followed by none other than energy at 6.19%, followed by utilities, industrials, consumer defensive. My thoughts on this is basic materials is up because not only oil obviously is affected during the current turmoil in Eastern Europe, but also other products such as wheat and I think wheat primarily, and barley, of course, that are heavily derived from those areas, such as the likes of Russia and Ukraine. That's why basic materials has been outperforming this week. For the underperforming, so underperforming are the technology and the banks, financials, and consumer cyclical. Since the start of the year, energy has been outperforming. Believe it or not, we're entering the third month of the year, and energy is still rock and rolling. It's up 23.7% as a group, followed by now basic materials. Since most of we just discussed the commodities have hit their highest rise for the past decade. 2008, so more than a decade. It's now 2022. So aside from
oil is like 109 a barrel now.
I think it's even more than that. I think it's 110 and a little bit more. I'm not sure.
It was 110 earlier this morning.
Yep. Right now, we open 115. According to this one, they range 109 to 119. Wowie. Oh yeah, you're right. 110. So it almost reached today at $120 a barrel. This is Brent oil. This is like what is globally, where oil is globally traded on, Brent crude. For the US, it's West Texas Intermediate, if that sounds familiar. But yep, oil is definitely going up there. And Wawi, I'm not sure if you've seen that report by JP Morgan that if the Eastern Europe war continues and the oil is not being accepted from Russia, by other regions, which is currently ongoing, oil could skyrocket to 185 barrels, $185 per barrel. So that will be quite an impact for sure.
Yeah. Well, we're already seeing some evidence of that locally.
Yes.
Um, a gas station there in Mount Vernon, Texas,
Hmm.
um, does not have any diesel today. I was just driving down towards Mount Pleasant, and they
Right.
were out of diesel.
So they out of like their products. They're out of storage, I guess.
Well, they didn't
Out of
have
stock.
any diesel on. They're out of stock on their pumps for
Gotcha.
diesel, but they have gasoline.
Wow. Well, that's one, anecdotal evidence to take note of for sure. So energy is the best performing sector. Now basic materials is catching up. They turned positive, up 2.94%. And the rest of the sectors are in the red. So if you're not invested in oil or commodities, your portfolio is probably negative this year. And the worst performing sectors is technology, 14.8%, followed by, and the worst ever, no, worst ever industry so far this year is consumer cyclicals. So for the volatility for the past week, it's up 3%. Not quite a roller coaster as we have been last week, but it's still up there at 30 points. Since the start of the year, the volatility for the S&P 500 is up 84%, almost 84%. So it's been quite a rocky year. The volatility for the Nasdaq, which contains the tech companies and listed in the stock market, it's down this week, down 2% to 33. But since the start of the year, it's still up 58%. So it's still been quite a rocky ride for technology.
Yeah,
For
they're hit hard.
Mhm.
Nasdaq companies have been hit hard. Some of them are down 60%
Wow.
since January.
Right. Now that you mentioned it, it kind of reminds me of an article that I saw, which I could share later about Kathy Wood's investments in those tech companies, if I could pull them up in a Google search. But right now, we're going to jump onto our next slide, which is the put call ratio, which usually is the tail that wags the dog, as we would like to uh, uh,
Mhm.
identify with. So right now the put call ratio, so the higher the ratio goes, the bearish the market is or the investor is. So right now we're still bearish at this point in time compared to its average. For the valuations of the S&P 500, currently this is as of March 3rd this morning. This is a source that I got from Yardeni Research. S&P 500 as a whole is 18.6 times. And if you guys haven't listened to our previous podcast, the average or the median falls around 15 times. So we're still at a premium. We're a little bit expensive. Not as expensive. A couple months ago, we were at 25, 26 times. Now we are at 19, almost 19 times. Removing technology, S&P 500 valuation goes down to 17% or 17 times. So still a little bit of premium, but as you can see, since the start of the year, we've been going downhill. So prices have gotten a little bit cheaper at this point in time. Forward price to earnings of growth stocks, they're still quite a little bit up there. As you can see throughout its history for the past 2 decades, growth has always been, priced at a premium, a little bit more expensive compared to value. So growth at this point in time is 23 times, value at 16 times. So if you want to be safe, you might want to buy a value stock. A value stock usually is trading in terms of its ratio less than what is currently in the S&P 500. So S&P at 18.6 times. If you find a stock trading less than that, and it's steadily growing with less debt, with the price to earnings ratio probably not more than 30 times, or not more than 19 times, I'm sorry, and decently growing their business or profits, then that will be a value stock. So for our miscellaneous charts, before we jump on that, I found the graph which kind of reminds me of ARK's investments. So, like what we said, some of the growth stocks have suffered quite a big dip. So, if you're going to look at the Kathy Wood's ARK portfolio, from peak to closing price as of February 28th, just look at the crazy drop in stock prices. So, Berkeley Lights, I'm not sure what the company is down almost probably 90% since ARK invested in the stocks. Robinhood Markets, the app, which sunk a hedge fund called, was it Melvin Capital, or is that the name of the hedge fund manager? But Robinhood came up to the highlights, or to make some news last year around this time, because they were able to facilitate a huge upsurge in GameStop and AMC stock, just because there are hedge funds betting that the stock price would go down. So most of these traders came from Robinhood and bought up a lot of stock in those companies and squeezed, did a short squeeze on those hedge funds and caused a lot of pain and losses to those big fund managers. 2U, I'm not sure what that is. Invite, Compugen. Some more familiar stocks are Teladoc, lost more than 60%. Roku, a little more than 60%. Zoom Video, about 60%. DraftKings, down about 65% probably. Roblox, down 60%. Shopify, almost 60% loss. Square, formerly Block, formerly known as Square, almost down 60%. Tesla, down more than 20%, or mid 25%. Coinbase, more than 40%. So, yep, a lot of growth stocks. Definitely those that don't have earnings have quite lost a good amount of capital or market price for sure. So, going on to our next chart here in miscellaneous, the probability of a rate increase on March 16, this is 2 weeks from now, has jumped into a quarter point, which is 0.25 from a half point percentage. So it quite right during probably the collapse, or the wave that's happening, the war that's happening in Eastern Europe. The half point increase in rates have gone, the chances of it being such as of the FOMC meeting, or the Federal Reserve meeting, has gone to zero. But
And that's based on the statement that Jay Powell said, right?
yep, Jerome Powell released a statement yesterday. I think I got it here, right here. So he said, quote unquote, "I'm inclined to propose and support a 25 basis point rate hike. The bottom line is that we will proceed, but we will proceed carefully as we learn more about the implications of the Ukraine war for the economy." So more likely, Jerome Powell has telegraphed this very clear, that we're going to have a 25 basis point hike, which everybody was kind of like thinking of, except for some analysts there. And I think Bank of America, they were projecting like half a basis point. Not just them, but other Wall Street banks as well. So this is a chart that I saw. I think this is a JP Morgan chart. Yep. So they just this is very important, sort of. So history don't repeat itself. History doesn't repeat itself, but it rhymes. So this is a good chart from JP Morgan, where they have the Gulf War and the current war in Russia and Ukraine. So the Gulf War was between Iraq and Kuwait. They kind of like indicated here how much oil jumped during the 1990 to 1991 Iraq-Kuwait war. Oil jumped 4.2%. Gas did nothing. Metals did nothing. Wheat did nothing. Excuse me. But this time, the current war, Russia and Ukraine, at 2022, actually just happened. Just today, we entered the 8th day, right? If I'm not mistaken. Oil is now up 8%. Gas up 5.6%. Metals, I don't know if this is a dash, but I guess metals is up 2-44%. That's crazy. Some of the metals are now 44% higher. Wheat is up 8%. So inflation, to add fuel to the fire, inflation is up 7%. Whereas back in the Iraq-Kuwait war, it was just up 4 to 5%. The stock market, the European, oh, well, let's skip the European small caps. Let's go right away to the S&P 500. So peak to trough during the Iraq-Kuwait war, the S&P 500 lost 20%. And during at this point in time, since the start of Russia-Ukraine war, we're down 9%. So if history rhymes, we have something brewing for sure underneath us, and we're not sure if it's gonna further go down, which is quite worrisome. But yeah, well, we'll see how it goes. So that's it for the sentiments and valuation chart. So despite that, some analysts are kind of like, Morgan Stanley's always been saying about their fire and ice statement, and so far they have been right. Morgan Stanley's Mike Wilson, definitely, as he have been freely giving those interviews in Bloomberg. So this is an article that was just published a couple of days ago after the Ukraine and Russia war started. So this is entitled, "In a Challenging Environment, These Stocks Are Delivering What the Market Wants to See," says Morgan Stanley. So according to this article, well, I'm just going to quote Mike Wilson here. Quote unquote, "Our work suggests that the market is paying up for companies that have a better chance of delivering earnings in a more challenging operating environment. Rather than growth or defensiveness, the market wants operational efficiency." So operational efficiency defined as low capex over sales growth and employee turnover. So a lot less turnovers for an employees, low capital expenditures, and consistent sales growth. So in this article, there's a long list of stocks. For listeners who are interested in getting this list, just send us a message in Facebook or on our email at markuwawishow@gmail.com and forward this to you. If you want to join the group, just send us an email and we'll freely add you. Or you can send me a tweet too in Twitter at marku_dpt. So the companies here, the top quintile of operational efficiency in sector, and what Morgan Stanley overweights in terms of like probably portfolio allocation, overweight on these companies. Probably we'll just go through 10. Number 1 is Coca-Cola, 2 Walt Disney, Chevron, Wells Fargo, Qualcomm, Philip Morris, Uber Technologies, Becton Dickinson, Eaton Corp, Edwards Life Sciences, and Northrop Grumman. So these are some of the companies that they are bullish on for sure, overweight. So in terms of fund flows, on our next headline, no signs of equity market capitulation yet. So mind you, this is an article that was published about a week ago. So it's just a survey that Bank of America does, just tracing where the money is going. So usually this kind of helps. So global equity saw a chunky 7 billion flow into cash and 6.2 billion of inflows into equities, while investors pulled 3.5 billion from bonds. So among notable flows, money has been going into investment grade and high yield and emerging market debt. Okay, correction on that. Looks like investment grade, high yield, emerging market debt saw biggest outflow in 3 months. So people are pulling their money from those investment products. According to this analyst, quote unquote inflation shock means rate shock, which means growth shock. There's a lot of shock in one sentence. Translating into negative returns in credit and stocks in 2022. They expect cash, volatility, commodities, and emerging markets to outperform credit, stocks, and private equity this year. So cash, more volatility, commodities, and emerging markets to outperform. So far that's what's happening. Commodities are slowly now outperforming because of the war. It's been a little bit more volatile for sure. In emerging markets, I'm not totally sure about emerging markets. I haven't seen any like outperformance in emerging markets at this point in time. So now we're gonna slowly dip our toes into what's going on in the financial markets concerning what's going on now in Eastern Ukraine. So CalPERS, this is the largest pension fund in the United States, has now ceased new investment flows into Russia. This was just published this afternoon. So they are now ceasing all transactions in Russian public traded equity or the stock market and has stopped the flow of any new investments into the country due to Russia's invasion of Ukraine. So total investment by the pension fund itself is 0.17%. So it's not as if it's a huge move by CalPERS, but
yeah, everyone's moving out of Russia.
Yep.
They've cut off several banks, except for banks that are dealing in energy. They have not touched those yet, from what I heard.
Yeah, there are some small banks that have been suspended or taken out of SWIFT, which is a SWIFT is like an organization of like more than 2,000 banks worldwide. So with their connection, they can actually do business transactions in a split second. And so they definitely Western allies have already kicked Russia's biggest banks in that SWIFT organization. So another fund that's definitely negative on Russia is the Norwegian Oil Fund. This is the largest fund in the world. It has 1.3 trillion oil fund. So right now, if you have stocks in Russia, you may have already seen the turmoil that it has done to your investment. So, for example, I think Gazprom, which is the largest oil company in Russia, is now down 99% since the war has started. Sberbank, Russia's biggest bank, is down 99% as well, down to the penny. So everything else is going down to zero. There was an interview this morning that I saw, but it's all in Russian, but it has subtitles. And the analysts for their stock market just came out with a alcohol bottle. I don't know if it's a stunt, but he said that everything else is going down to zero, and I'm gonna cheers to that, and I'm gonna be working as a Santa Claus pretty soon. So he has some quite humor to it, but everything is not looking so good if you're an investor in Russia. So here's an article from Fortune magazine published this morning. We can't sell our Russian stocks. Russian companies are being erased from stock indices as Putin-Ukraine invasion makes them uninvestable. So yeah, I think I shared this to our messenger group. If I can scroll quickly, browse through it. I think FTSE, if I'm not mistaken, FTSE, which is a European stock market index holder or provider, will be kicking out all Russia stocks from their indices, and also MSCI, which is one of the largest, if not the largest, fund producer or portfolio organizer here in the US. So the market value of Russian holdings, at one point, they were at near $30 billion. At this point in time, you could see it's almost close to zero, according to Norges Bank. So as a result, so people are exiting Russia, don't want to risk it, or already suffered heavy losses such as yours truly, which I mean, you can't tell where the stock market is going for sure. So Brazil is ending up with a boost because of the Russia outflow. Latin America biggest market may draw 1.3 billion dollars. The index, Brazil's stock market index, has gained 22% so far this year. So some people may be thinking of moving their funds, or probably by default, they're choosing to go to Brazil after taking out their money from Russia. So this is what I mentioned earlier. JP Morgan says $185 per barrel if Russia's supply hit persists. 66% of Russian oil is struggling to find buyers currently. So despite the cheap, I think the cheap oil that's coming out of Russia because nobody is buying it, there's no demand for Russian oil, which is kind of like contrary to the fact that we do need oil to grow the economy. This is people or big companies avoiding Russian oil because they want to avoid sanctions. They don't want to make dealings with Russia at this point in time because they don't want to pay a huge penalty if find out they'll still make doing business with Russia. So there's no demand at that point, at that area. So Exxon, the largest oil company here in the US, faces 1 to 2% hit earnings from a Russia exit. So they're exiting Russia as well, not giving any new investments on that area, on that front. On our next headline. So this is the commodity. Commodity prices soared to highest level since 2008 over Russia supply fears. Raw materials cost to post biggest weekly rise since 1970. So this chart has been popping. It's about technology. So we're going back to tech. So there's a lot of tech that are now hitting 1-year lows. This is the highest ever, according to a Bloomberg study. Highest in more than 30 years. So if you're definitely looking for bargains, you might want to check out some of the tech stocks that are surviving out there. Might as well look for cheap ones as well as growing in terms of their earnings and also with a lot less debt. That way that company may survive. So this is Powell, an article regarding Powell's decision to hike the rates by 25 basis points despite the war impact. So I guess it come to fruition, Huawei, like you estimated. It's going to be a 25 basis point hike.
Unless something escalates. But I think the U.S. economy is still in a good position at this
Mhm.
time. The ripple effect of oil squeeze may affect us for the short term, but it's not unusual for tech stocks to go down like this. It's happened before.
Right.
Um, so if you have good conviction on your tech stocks, you know, if you're a long-term investor, after 10 years, you may look back and say, oh, it's not that bad.
Yes. In fact, it may be, in hindsight, maybe a best time to have bought some stocks during the sell-off.
And
Yep.
we're seeing evidence of that people are still buying on the dip. So,
Hmm. Yeah, and
but
come to think of it, oh, go ahead, Huawei.
but definitely, seeing a lot of good movement from, like, if you look at Nextera Energy got like 1.6% today, and a lot of the some of our, like, REITs, like Stag Industries is up 1.76, and Walmart up 2.3%. So that kind of gives you an idea what companies, investors are buying right now.
Hmm. Still
Oh,
definitely.
yeah.
Mhm.
Yeah, I forgot to say transport. Okay, transport. Um, you know, I don't know. Some of the trucking companies are not doing so good today. A little dip here,
Hmm.
but looking at cargo shipping company like Zim, it's got a good momentum. So if you're a trend follower, you can ride that wave, but you just have to know when to exit, because it's really at a fast momentum right now as far as that shipping company is concerned. And surprise, surprise, Best Buy finally showed up today at 9.22%.
Wow.
So
The good
that's
earnings because of good earnings. Best
I don't know if they reported their earnings, but it just showed up on my screen. So
up 9%.
mhm.
Oh, here we go. There's a CNN article regarding this upsurge in stock. So Best Buy shares pop as investors bet pandemic gains will outlast fourth quarter supply chain and staffing hiccups. Ooh, look at this. There's a breaking news. Futures are down. This is red hot from CNBC. Futures are down 300 points following reports of smoke at nuclear power plant. This is not good.
Oh no.
If this is the one in Chernobyl, let's see. Stock futures Thursday evening. Uh-oh. War in Ukraine, the largest in Europe. Okay, evening following smoke was visible from a power plant in Ukraine, the largest in Europe after Russian troops attack. Rapidly deteriorating and reports the country are difficult to confirm. So we have to closely track this and hopefully, everybody stays safe. But I mean, it's going through the wires, definitely not doing any good. So we're
Mhm.
going to skip back to Chamat, an article regarding this SPAC guru back in early last year, that was teasing everybody to buy, or at least encourage everybody to join in the SPAC mania. So this article was just published yesterday. Chamat Palipatia sued over insider sale of Virgin Galactic shares. So I think at one point he was a chairman, right, Maui?
Yeah, I think so. I think so.
With the board last month. So Chamat Palipatia took advantage of his insider role as a chairman. He is a chairman of Virgin Galactic Holdings to sell 10 million shares for 315 million before he abruptly quit the board last month. So he probably tried to front run all the others by selling his shares before everything goes down. But we'll never know what his strategy is. Maybe he's trying to pad his bank account to pursue another investment journey.
Hmm.
So this is
Unlikely.
mhm. And this is an article from Reuters, published February 28th. As some of our group members have noticed, Berkshire Hathaway came out with their report last week. In summary, they've been buying more of their stock instead of like buying or making mergers and acquisitions, as typically what would have been if Buffett has found any discounted company out there.
Hmm.
So this article says Buffett doubles down on boring Berkshire. So he's been buying a lot of Berkshire stock. I think right now his cash, yeah, there we go. His cash position is about $144 billion, roughly half the size of oil giant Chevron. But regardless, he's been just actively buying his own stock instead of
Hmm.
making deals out there. Basically, that's it. So now we're going to jump on to our weekly Roll the Clip segment. And on this segment, it's none other than, of course, the Permabull,
A
Tom
permabull.
Tom Lee of Fundstrat. This was published on February 28th with 103,000 views. Tom Lee, market low likely locked in for year's first half. So we're probably seeing the lows right now for the first 6 months of this year. Let's play the segment.
Gaining steam. Tomorrow's State of the Union, at tomorrow's State of the Union, the mask is optional. New York City ends its vaccine mandate next Monday, and states from New York to California are dropping mask mandates entirely. The backdrop could bode well for reopening trades. Tom Lee has been bullish on them for over a year. He runs Fundstrat Global Advisors as a CNBC contributor. Tom, great to have you with us.
Yeah, great to see you.
We were talking about Russia, Ukraine at the top of the show, but this sort of folds in. It's all the markets. Is the reopening and the strength of the possible reopening, is that sort of offsetting any sort of downside action we could be seeing from the impact of war?
I mean, to an extent, yes. I think there is pent up demand because, for the last 2 years, people have been home and there's been a lot of anxiety. And I think, even Starbucks had noted there are more unhinged customers. So I think as masks come off and we move away from pandemic thinking, I do think businesses start to see workers come back, business travel comes back. And I think it is all a virtuous circle. But I think the bigger sort of reason markets are stabilizing is very likely because the Fed, which people thought was turning quite hawkish, ends up having to make, I think, an incrementally dovish pivot.
A dovish pivot meaning to 25 or even more dovish than that?
Yes, to 25. I mean, and I would just say it's as Tom Luddy, former JP Morgan vice chairman, likes to say, less bad is good. And I think if the expectation has gone from 50 basis points to 25, I think that is incrementally dovish.
Hey, Tom, it's Karen. Thanks for being on. So if they were to proceed in that dovish scenario of 25 and several 25s, what's your outlook for the market then and the economy?
Well, and as that chart shows, the market expectations have dropped sharply. But I think that the question we'll probably ask at the end of this year, and that's a long ways away, is whether, a 2% 10-year or even 2.25 is bad for risk assets or even bad for the economy. And I think markets will probably conclude that it's still supportive of PE expansion. And that's because today you'd still be paying a 40 multiple for a 10-year bond, and investment grade is still going to be in the 30s and high yield is going to be mid 20s. So equities, which are now sub 20, still look like a pretty attractive investment bet. And of course, that also feeds into the idea that if rates are rising, you're not going to make money on credit, but you'll make money in equity. So there's a guaranteed TINA.
How much time do you think market participants are underestimating the strength of this reopening? And I'm asking this because I feel like every step along the way, people have been skeptical of it. You've been pretty bullish, and your view has largely turned out to be right.
I think investors are still have low conviction on reopening. And that's because when they talk about supply chain glitches or inflationary pressures, they tend to think of it as margin pressure for stocks that are reopening. So I think there's a tendency to think the durability of any rally is short-lived. I mean, you could see it in the way stocks really sell off on any word of inflation. But it's not that different than how investors were extremely skeptical of energy stocks in 2021 because they didn't think energy would be around. But even in 2022, energy has been performing pretty well.
And before we let you go, Tom, I got to ask you about Bitcoin. That's part of your beef trade, although it's Bitcoin equities. I'm curious, are you surprised at how Bitcoin has traded? I would have thought that with the onset of the skirmish, the war going on in Ukraine, that Bitcoin would trade higher, not because it's a safe haven at all or a store of value, but maybe for other reasons, like the notion that there needs to be an alternative payment system developed and other ways to move money around the world other than traditional means.
Yeah, I mean, I think it depends on your measurement, where we start to measure performance. But I think over the weekend, there were several things that made Bitcoin quite useful, right? We know that the Ukrainian government, the prime minister, was actually making a request for donations in crypto. And with the SWIFT actions, we know Russia, if you look at the ruble exchanges, Bitcoin volumes were through the roof. So in times of uncertainty and when essentially access to traditional financial systems gets cut off, people do turn to crypto. I don't know if this is the moment Bitcoin had to go parabolic, but I think it's really showing its use case again. And I think Bitcoin equities, so we the B is Bitcoin, the E is Bitcoin equities. They did quite well today because, again, U.S. mining is really moving into the U.S. So I think Bitcoin equities, especially whether it's Silvergate or the miners, are actually turning to equities that could actually boost performance in a portfolio.
Tom, thank you for your time. Good to see you.
Thank you.
All right.
It's interesting that they talked about cryptocurrency in Ukraine. The prime minister in Ukraine has decided not to do any airdrops for the donors.
Mhm.
They just received, as of latest report that I got, 50 million US dollar worth of crypto from about 90,000 individual addresses.
They're in Ukraine.
Yes, and they're gonna use
Mm.
that to buy supplies, military, and I guess food, and for for the people and the fighters. There's still a lot of civilians there. 1 million has evacuated, but I think there's maybe 40 something million people there that still need help.
Yep.
And help is pouring in via crypto. And they're gonna, the minister said that he's going to give away some NFTs for some of these donors.
Right. Well, I guess hopefully everybody stays safe out there because Russia looks like pretty set to what they want at this point of
Yeah,
time. So
Kiev has,
Mhm.
the capital has not yet capitulated, so
Yes.
the second largest city has been occupied already, from what I heard,
Right.
but Kiev has not yet. Uh, they have not taken over Kiev yet.
The capital. Yep. Well, Wally, do you have any quote for the week for our listeners?
I don't have any quote for our listeners.
Uh-huh.
Just remember to, that this is usually what happens when we have, you know events like a war. Things will become volatile,
Yep.
but then it's not a permanent thing. Let's pray that it's not a permanent thing.
Right.
uh, Usually it's short term, and the market recovers, and our lives go back to normal.
Well, Wally, thank you so much for coming on. And
Thank you, Mark.
listeners, that's it for this episode of Mark You and Wawi Show. Send your questions to markyouwawishow@gmail.com if you have any or suggestions. And remember, build that emergency savings and invest the rest for an abundant retirement. A bountiful week ahead. This is Mark You signing out.
Bobby Santos signing out.